just a passion for creating wealth. It's the reality of what we do. If you look at our clients with a beginning investment of $500,000 on April the 1st, 2009, by the end of last year, that would have grown to 7.4 million. The average financial advisor doing based on studies that have been done by Schwab, by Investment News, by BlackRock, their returns would have been 1.2. What makes the difference between 7.4 and 1.2? You know, we always say buy low, sell high, but why don't most people do it? You know, you can look at what my clients have done. What's the difference? How do I do it? Why do I do it? And how does it work? That's what we're going to talk about today. That's what, if you stay and listen to what I have to say, you'll learn a lot of why that happens. Why my clients go from 500,000 to 7.4, and most financial advisors clients go from 500 to 1.2. That's what we're going to talk about today. And why do we say buy low and sell high, and people do the exact opposite? You know, it's not because investors are unintelligent. It's not because it's people predicting the market best. It's not because of picking the hottest stocks. You know why? Because we avoid making emotional decisions. We avoid making the big emotional mistakes. You know, in order to achieve really good returns, we have to look at what we're doing on the numbers, not just on the emotions, not just intuition, but really look at the numbers. But the reality is we're human. We're human, and our brains aren't wired to reason in probabilities. We're not computers. Big money managers and hedge funds and others use computer algorithms. They can take a huge amount of data. When you're an individual investor, we're not wired to be perfectly rational. Our brains don't sit there calculating the probabilities. Our brains are not wired to eat every possible outcome. We don't analyze every single variable. What we do in most cases is react. We chase the winners, or people mostly change the winners. We look at what's working, not looking at the probabilities. You know, we try to avoid, as humans, we try to avoid what's uncomfortable. When a stock's going up, you feel really safe. Investors feel really safe. When a stock's going down, it's really a difficult feeling, a hard feeling. We want to be on a winning team. And when a stock's going down, it feels like a failure. It really does. And it gets worse. Most people don't even make decisions based on facts. They make them based on memory. We remember the winners. You know, that's a normal thing. I remember the winners. I remember the losers. I don't want to have the losers. I want to have winners. And when it's time to sell, most people have the pain of being wrong. How often have I heard the phrase, I just want to wait until we break even? I started my career as a traditional stockbroker. And in that case, we were calling people and saying, I recommend buying this. Or if a person owned the stock, I recommend selling this. And most often, you know, the reality is if you had a stockbroker that was making those kind of recommendations, when stocks went up, clients felt they made a good decision. When stocks went down, it's because of the lousy recommendation from the stockbroker. Now, the reality was when stocks were down, people had a really difficult time thinking, I want to buy more of this. When stocks went up, they were happy to buy more. I used to talk about the situation where if you knew a stock was going from $10 to $40 in 5 years, what was the best scenario? If the stock went from $10 to 35 in the first 6 months and then went from 35 to 40 in the next 3.5 or 4 years, was that the best thing? Or was it best for that stock to be $10 until 3 months before it's going to go to 40? It's much better for the stock to sit there and languish. You know, it's much better to sit there and know that the stock that you own, especially if you're investing more in it, stock is like the EKG of a dead person. If you're investing more in it, why not have that if you expect it to be higher? The fact is, those things play into it. And we're going to talk later in the program. Don't go away, because we're going to talk about how we achieve what we do and why. It also comes down to who you listen to. Now, I'm not a very good presenter. I present as I am, but I'm not charismatic. I know that. I know that my presentation is pretty just straightforward. It doesn't have bells and whistles and gimmicks and whatever. And I've listened to other presentations. I've listened to people who do presentations, and they sound real good. Sometimes they sound excellent. But who is it that you listen to? The most recognized person in the financial industry is Jim Cramer. But have you ever noticed, if you listen to Jim Cramer, and I have it on a lot of times in the office because I have CNBC on my TV in the office all day long. Sometimes I listen to what he has to say. Have you ever noticed there's no one that calls in with a negative comment? No one calls in and says, Jim Cramer, you told me I could not go wrong buying Bear Stearns at $72 a share. And yet now, 3 months later, it's 2. That's an actual situation. John, that was pointed out by John Stewart on his program. The Cramer recommended a table pounding buy of Bear Stearns at 72, and 3 months later it was 2. No one calls in and says that to Cramer. All his calls are screened. If you want to say good things to Cramer, you get through and you can talk to him. Those calls, the bad calls, never make it 2. And he did recommend Bear Stearns at 72, and it did go to 2. John Stewart made that on his program in March of 2009. Barron's published a study they did in August of 2007. They looked at Cramer's recommendations, and they said he underperformed. Barron's found he trailed the S&P 500 by 4%. S&P was up 16, Cramer's recommendations were 12. CNBC then came back and said, Cramer's recommendation, his program's educational. It's not about stock picking. They tried to say if you bought and held stocks for 1 or 2 months, you would do better. Barron's found that was false too. And you know what CNBC did? They banned Barron's from ever advertising on CNBC. I recently saw an ad, first time I've seen an ad for Barron's in 20 years. Since 2007, they've been banned. But people listen to Cramer, and they think that he knows what he's saying. But he doesn't publish numbers. He doesn't say, this is what it is. Cramer's focus is selling advertising. That's his agenda. But people don't think about that. They think about what he says about stocks, not about how he does, not how the stocks perform, and not ever thinking, why no one calls in with a negative comment? No, everything's positive. The big firms and the small firms tell their finance advisors, sell the relationship, not the performance. That's what they do. And no one has a crystal ball. No one can say, this is going to really do well. Economic laws are not like the laws of gravity. If you stand in your driveway and throw a 10-pound steel ball in the air, you can count on that steel ball coming back down. But looking at the economic picture, you can't say how things are going to work. Times change. The stock market is driven by millions of people making millions of decisions, all based on everyone having a unique outlook, unique personalities, unique philosophy. So the firms, they want their clients to like their financial advisors. The financial advisors want to build the relationship, become friends, and they begin to play on rules of the game. And the rules are rule number one is, oops, I got ahead of myself. Their rule number one is don't lose money for your clients. That's their number one rule. Don't lose money. That's why the big talk about volatility. Volatility, stocks go up and down. Everybody knows stocks go up and down. That's not a question. But that's not real risk. That's not stocks going to zero. Stocks go up and down. But the big firms, the small firms, the financial advisors, rule number one, don't lose money for your clients. Don't let their stocks go down. Don't let their client accounts go down. Rule number two, don't forget rule number one. Rule number three, don't forget rule number two. We live in a time in which we have a lot of ups and downs and a lot of volatility. And there's a very, very big difference between a normal correction. We have corrections every other year. 10% down, that's just normal. That's just stocks trading in and out. We also have corrections that are based on the economy suffering, the economy going down. We're coming to one of those times. And how you deal with that is very different from how you deal with a normal correction or a normal dip down 20%. In corrections, people say a correction is 20%, a bear market's or correction is 10%, bear market is 20%. There's no economic rule that says that. There's no reason to say a correction can be 9.23% or 11% or a bear market. But over the long term, looking at corrections and the market down, that's normal volatility. In an economy, in a real bear market, not a bear market where the stocks go down 20% and recover, that's not a real bear market. I'm talking about a bear market like 2000 to 2008. There, the economy was up a total of 2% for all those years. That's an average of 0.2% per year. And you know what happened in 2007, 2008? Things crashed down. The economy was in recession. Revenues were declining. Earnings were declining. During a real economic downturn, economic chaos, you come to an old Chinese proverb. Old Chinese proverb said, a rising tide lifts all boats. During good times, everything goes up. During good times, generally all stocks rise. But it's when the tide goes out, as Warren Buffett says, it's when the tide goes out that you get to see who's swimming naked, because the good things, the good stocks will continue to move forward. A few of them, it's been in those stocks. The duds really fall off, but most stocks will suffer during those times. It's understanding that there's a difference between a normal correction or what we call a down 10% or down 15 or down 20%, just due to normal fluctuations in the market and due to an economic turn down. That's one of the most important things to rule. But if I were to give my number one rule in managing money, in making money in the stock market, and really creating wealth, my number one rule is don't play Wall Street's game. Wall Street, you're dealing in Wall Street's game with people that have a multitude of computers, a multitude of analysts, a multitude of people analyzing every bit of data that goes in and out. You have quant hedge funds that are all based on an algorithm. Something like 95% of the trades done are done by computer algorithms without any human input. The algorithms, the computers make the decision to buy and to sell. And they issue multitudes of orders, multitudes in small increments. And they pull back those orders if things really change. For me, I'm looking at the big picture. If you want to know how I get from 500,000 to 7.4 million, I look at the big picture. I want to look at where a stock and a company is going, not in 3 months, not next month, not tomorrow, but where do I expect it to be in 5 years or 10 years? I want to know what the long-term outlook is. I want to know what to expect long-term. There are now such a focus on short-term returns that there are some money managers now that are working on firms, working in pods, where they're rated on a monthly basis. If their stocks and if their portfolios are up after 1 month, they get to manage more money. And if the stocks are down after 1 month, money is taken away from them. That's focused on a 1 month outlook. Even if you look at other things, most of those firms, most of Wall Street's game is to look at quarterly earnings, analyzing, looking at quarterly earnings. How are we doing this quarter? Did the stocks, did the companies report earnings that made the estimates, or were they short, or were they long? The reality is, it's not the companies that missed earnings. It's the analyst projections that missed earnings. It's the analyst projections using their models and what they think should happen that missed the earnings, or or the company's earnings are more than they expect. The companies report their revenues and their earnings. The analyst, it's not the companies that miss the earnings. It's the analyst projections that miss the earnings. And when you understand that difference, I think it gives you insight into looking at the company's longer term. Not playing Wall Street's game, looking at the quarterly earnings, but looking at the long term, looking at where they are. If a company's earning revenues are up 20% and their earnings are up 20%, and the analyst said they should be up 23% or 21%, there's no reason for the stock to fall off 20%. That's just, in my opinion, stupidity. But that's Wall Street's game. And I have to say, institutions and money managers love retail investors. They really do. They love it. You know, those are the people they call smart money. They consider retail investors dumb money, because for every happy buyer, there's a happy seller. So when you're buying, you got to know you could be buying from institutions because they have more information than you do. If you're playing their game, I don't play their game. I want to look at the big picture. And I want to look at companies that are involved in changes in demographics, changes in lifestyles, changes in technology. And we're going into a time in which I believe we're going to see a very chaotic time. We're going to see very possibly stagflation. And if I look back at what happened in the last stagflation period, what we saw was stocks in 1966, when it all began, stocks went down 20%, recovered, went down 30%, recovered, went down 40%, recovered, went down 20%, recovered. Bonds were a complete drop. They just crashed during that period of time. Commercial real estate struggled during that time, or not so much during that time, but especially in the aftermath of that. It was not a place to be. Nothing did well. But a few stocks did do well. There were changes in lifestyles. A little restaurant company where they didn't even have a place for you to go in and sit down. You had to drive up and order your hamburger and milkshake and French fries. That company grew tenfold during that time. Tenfold. While everything else went down and just back to break even, it went tenfold. And that was a change in lifestyles. There was a change in technology. A little company that had started as a radio repair shop in Colorado realized the potential of the transistor, became a significant distributor of transistors. That company grew 20-fold during that time. And technology also played a part in a company that had random access memory. Advanced micro devices grew hugely during that time. So I'm looking at changes in demographics and lifestyles. And it's not a simple process. It's not simply listening to somebody talk about a stock somewhere and saying, this is a good buy. It's not talking about quality stocks. It's not talking about some of the things. Because some of those quality stocks during that period of time, companies like Woolworth, American Tobacco, Union Carbide, those companies died in a con of copper. Those were companies that were the bluest of the blue chips, but they weren't where the changes were happening in demographics, lifestyles, and technology. Those being in high quality stocks, which all of those were high quality stocks. Sears, high quality. Everybody shopped, or almost everybody shopped at Sears. They died. They died. It was the changes and the new companies that came. It's not an easy process that I take. Every month I look at 20 to 30 stocks. It's a preliminary look, not very much in depth. 8 or 9 of those, I will look at the financials. We'll look and see if they make sense financially, and especially the balance sheet. I'm more a balance sheet guy than I am an income statement guy. And then for ones that I find interesting, I'll take the time to look at 1 or 2 and dig into the 10Ks and the 10Qs to see what I find. And that's especially true. I do some shorting for our profit sharing accounts. I do some shorting. And in shorting, I will look for red flags. That's my focus on finding red flags, because if I can find 3 red flags in the 10Ks or the 10Qs, I figure there's a lot that I cannot see. Give you an example. For Beazer Homes, one of the red flags I found going into 2007, I found that Beazer Homes was guaranteeing the mortgages for the people that were buying their homes. Beazer Homes was a big home builder, and they were guaranteeing the mortgages. And then I looked at the balance sheet and found they had no provision for any mortgages that were in default. That was a big, significant hit if we hit a tough time. And certainly it did. Beazer Homes was down 70 or 80%. They had a red flag. They had 3 red flags. I found the 3 red flags. I shorted that stock. And so that's what I'm doing. I'm reading for red flags, because if I can find 1 or 2 or 3, I figure there's a lot that I can't see. The fact is, I'm looking at 1 or 2 stocks in detail, and then I only do 1 or 2 trades a year. I'm serious about taking the long-term look. I look at the stocks every quarter. I reevaluate the stocks, sometimes even more often than every quarter. And I listen to what people say. I listen to the shorts. I listen to the longs. Listen to people. Their focus is on short term. Mine is, where are we going to be in a few years? For me, the only way to win is not to play Wall Street's game. It's seeing where things are, and it's looking at the numbers, not listening to people who make a great story, but really looking at the numbers, because the numbers do not lie. Stories, you can hear great stories about stocks. Everybody can build a great story about almost any stock, and they can tell you great things about anything. You can listen to CNBC and listen to all the great stories that they talk about. You can listen to Kramer. You can listen to a number of people. You can read the newsletters for people recommending stocks. For me, you have to do your homework. You know? There are things that I don't do. I don't do my own car repairs. One, it's really a lot more complicated. So I take it to an expert. And I think that's why we have clients that come to us, because they realize that investing is an art. It's not a science. If it was a science, whoever had the biggest computer would always win. It's an art. And for me, the way we achieve our results is because we look at the numbers. We don't play Wall Street's game. And that's the number one ring. We're looking at the big picture. We're looking at the long term, not a monthly return, not a daily return, not a quarterly return, or even a yearly return. We're looking at the long term. We want to hold stocks for the long term. The longest stock I ever held from 1993 until 2018, when we began to trim it back. Still a few shares for a few clients in the accounts, because we are try to be tax efficient, looking at what the long-term gains are and setting them aside and doing tax loss harvesting against long-term gains. So we do trim back positions that we're moving out of, but we look at the long term. That's our focus. That's what we want to do. That's why we have the results we have. And these are the results. This is where we are. From the bottom in 2009, we grew a $500,000 account to 7.4 million. And you can see some of those stories, and I share some of those stories during these workshops. You can also see them if you look at our podcast. Our podcast, we're beginning to share stories. We're sharing the story of Ruth, started in before 2000, just before 2000, with 173,000. She's taken almost $1 million out of the account and still has 2.2 million. We shared her story. We shared Frank's story. Frank started with 108,000, turned to $1 million. He was knocked down, kicked in the head, permanent brain damage for over 25 years. That $1 million, actually, it was more than $1 million when that happened, but that provided specialized brain care. And tomorrow we're putting out this story of Alma. I've got story after story after story after story, because that's the kind of return we have. We want to share that with our people. We want them to know. And yes, we always have to say past performance is no guarantee of future returns, because, and we have a lot more. I always love this one because, as Peter Lynch said, it's always great to be fully invested. It's great to be caught with your pants up. And we know there's going to be times that are difficult. We know there's going to be times when not everything works out. Doesn't scare us. Volatility is the price you pay for returns. Yep, we're down here. And I want to say the numbers aren't in yet for the first quarter, but I'm guessing that we're going to be down around 15%. The market's down 5 or 6%. We're going to be down maybe 15%. I think it's an outstanding time to get started if you're not a client. If you're a client, you know what? Even if you bought in at the very top here, even if you buy in here, you're still, with the market coming down, you're still going to be ahead. And when we recover, even further ahead. And with that, I hope you understand what we do. And we do try to buy low and sell high. Hopefully, this was an informative and you understand how to buy low, sell high. With that, let me ask if there's any questions that you have.
Hey, everybody, it's Chris Prouty, and I am back. Mike, that was one of the best. I've seen you deliver many times over the past 6 months. That was definitely one of the best. I do have some questions queued up for you, sir. First question, and by the way, for those of you who are here today, thank you again for being here. The webinar chat is open for you. If you place a question in there, I'll see it for sure. If you send it to everyone, that means everyone here on the broadcast will see it. So if you want to include anything that might be sensitive, my recommendation would be to put it in the Q&A instead, which only I and Mike will see. Mike, a question that's come in. If I follow your strategy exactly, where would I likely underperform and why?
So if you look at our strategy, we tend to underperform 1 out of every 3 years on the average. Sometimes it's 2 in a row. Sometimes we have positive times 4 and 5 years in a row. But we tend to underperform because of the normal shifts in psychology in the market and people feeling, suddenly this stock is not, this company's not going to perform. Our focus is on the long term. There are going to be times in which our portfolios underperform, and they do underperform 1 out of every 3 years. I'll take that. I'm looking at the long term. I'm looking at 5 to 10 years, not next week.
Mike, next question. What do you think about physical gold and silver? Also, large established firms like NEM, Newmont, and hold on one second, AEM, which I'm trying to
Archer Daniels, yeah.
yeah. So first, what do you think about physical gold and silver?
So those are our physical product. They actually have use in manufacturing products. But the difference between a stock or bond is that stocks and bonds, stocks are ownership in a company. The company has revenues, they have earnings. You can see if they're increasing or decreasing. Bonds have a coupon, they have a maturity, they have a credit quality. All of that is measurable. With gold or silver, they tend to move based on what people believe, what people speculate. They'll change geophysical, pardon me, geophysical things will change what the demand is. Inflation will change what the demand is. They're considered, gold is considered an inflation hedge. So inflation is going up, you expect gold prices to go up. And you can own the physical quality or the company. Newmont Mining, Archer Daniels, all those are companies which you can measure their earnings and you can measure their revenues. They're not really as much an inflation hedge as some people consider. I don't think if you follow the inflation numbers, they're not going to be there. I also think there's a difference right now in what the Fed is saying. The Fed is kind of giving the current inflation analysis. They gave it in 2021 and 22 as recovery from pandemic. Now they're saying most of what the inflation is the tariffs. I think when you go to the grocery store, my wife goes to the grocery store, she comes back and complains about the increases in the prices. The prices in the grocery store are not necessarily the prices that are due to tariffs. They're they're real inflationary prices, and they're
Mm,
prices that are due to a lack of undocumented workers who are harvesting the crops.
mm,
Um, that's not going to go away. Tariffs may go away. We may get used to having constant tariffs on products, which would, if they were constant, means that they're not inflationary anymore. But not having the labor to pick the strawberries. Um, and have a person who's retired from Iowa who talked about a carrot farmer whose carrots were in the ground. He could not find the labor to harvest. And he says he's going to lose the entire crop.
wow.
What that means is carrot prices will go up because the demand for carrots will be there and the supply won't. So gold and silver, the original question, I'm not sure the inflation hedges are going to be the same as they were. But for me, it's much more predictable to be in the stock market and to find the companies that are doing well, the ones that have and are dealing with changes in lifestyles, demographics, and technology. For me, it's been the wonderful way to go.
Mike, I have another question queued up. What is the hardest part of your system to actually stick to?
When a stock is down 25%, it's hard to stick to it. You know, I have the same gut feeling everyone else does. It's a feeling, this is working. Peter Lynch said it, unless you can ban forever the thought that I'm a seller when a stock is down 25% and believe that I'm a buyer, you'll never have better than mediocre results. And when a stock is down 25%, it's or 30 or 50%, it's a time at which you really think, did I get it right? And once again, I come back to the looking at it long term. Where is it going to be in 5 years? It's down 25% now. If I believe it's going to be at my target price in 5 years, I'm going to buy more. If I believe I made a mistake, and I have in the past, um, bought a stock, had every thought that it had new technology, it had the right technology, it was going to work. Of course, the stock was 3D Systems. When the earnings didn't come through, they changed management. When the earnings again didn't come through, they changed management. Finally, after the third change, I said, I'm gone. It was just a mistake. I make mistakes. You just say it's a mistake and you move
Mm.
on. Um,
So, Mike, an observation, gold mining stock, which is, and I'm not sure, I'm familiar with Agnico Eagle, but they wrote Anico Eagle, has gone up a lot in the last 3 years. I think Dale might have meant Agnico Eagle, which is a mining company that mines for the largest gold producers in the world. I
I
think
know them very well.
they mine around the world. It says their stock has gone up in the last 3 years.
Um, I did own this stock at one time, a
Mm,
long time, a few years ago, because gold had settled way down and the demand was there. Um, and they had, based on a relatively flat price in gold, they were mining more gold and producing more gold. Um, it was not a matter of just price, it was a matter of production quantity that they were
mhm.
producing. Uh, there were so that's the reason that I own this stock. Now it's gone up because the price of gold has gone up. Uh, I've been around a long time. I remember when the price of gold in 1971 or 72 soared from $30 at $32 an ounce to 800,
Hmm.
then back to 400. So I'm not a speculator. I need to see numbers. And right now, I believe that that stock is overpriced based on the production of gold they're doing. If gold's, if the price of gold continues to stay up where it is, it's a decent buy. Uh, possibly, possibly. I don't know. I don't. But gold has a significant probability of coming down, especially if we go into a difficult economic time without inflation coming along with it. So,
Mike, next question, is Bitcoin and related stocks pure speculation, or is there any value inside of those stocks?
um, so Bitcoin, I think it's talked about digital gold. I think it's digital tulips.
Hmm.
There's no basis for it. Blockchain technology is blockchain technology, and it's an incredibly good technology. But to give value to an algorithm, no, it's all psychological. And right now, half the people that own Bitcoin are now underwater. Um, there's no physical basis for Bitcoin to be where it is. Um, you know, it's all based on speculation, what people are willing to buy. You know, I did a thing on tulip mania. You know, tulips, tulips back in the 1730s sold. You could sell a tulip bulb for 12 acres of land. You know, a tulip bulb. I think cryptocurrency is digital tulips. That's that's my take on
Mike, we just need someone to come along and eat a Bitcoin because they thought it was an onion,
it.
which
That
I believe is what happened in
it did happen in Tulip
Tulip
Mania.
Mania, if I
It sure
remember
did.
correctly. I wasn't there, but I've heard the stories. Mike, how do you handle periods when your strategy is underperforming?
I spend time, I come and I go through. No, I've been doing this for 40 years. So what I do today is different from what I did 40 years ago. 40 years ago, I used to have a notepad, now you can do it on a computer, but Word was new at that time. Um, I used to have a notepad, a notebook, and I would write down the reasons I bought a stock. Where did I expect it to be in 5 years, roughly? Um, and why did I expect it to be there? And when my portfolios are down, I would sit down and review my notes and I would update the notes. I would update. Right now, I carry a spreadsheet um, and I review that on a regular basis, probably more often than I really need to.
Hmm.
But I look at that on a regular basis. And so when I'm underperforming, I go back and I look at it and I say, do I still believe in the reasons I own these stocks? I sure do. Um, and uh, in the old days, I used to write it down. If I were starting over, I would still write it down.
Hmm.
Um, during periods of underperformance. And one thing is when you go through these once or twice or three times, you begin to take them and understand that volatility is the price you pay for superior performance.
Mm. Mike, somebody's asking about stocks like Exxon and Chevron and other major oil stocks. Are they worth looking at right now?
What's the 5 year outlook? You know, if you live, if you were, if for the people that are listening that were teenagers or older in the 1970s, you remember what happened? The the highest oil consumption per capita in the United States happened in the 1970s. And when oil prices went way up, and they were under $10 a barrel at the beginning of that period of time, they reached 40 or 50 or $60 a barrel. And I don't remember the exact figures, but the prices were way up. And what happened is cars that used to get 6 miles to the gallon in gasoline
Mhm.
now are getting 35 or 40. Something I thought was almost a dream that it would never happen, but it sure has. If you look at what happened with the power companies, they did deals so that you could put in double pane windows and save on heat bills. Everywhere you looked, there was a big push to conserve energy. There was a big push to conserve oil consumption. And it had an impact. It had a huge impact because the consumption per capita of oil is in decline. And if we continue on this path where we are, the decline of oil will continue. We're already replacing a lot of electrical needs with solar and wind and geothermal. The higher the price of oil, the more economical it is to put in solar or wind or geothermal. Uh, Wind is the most effective of all, but solar is growing at 30% a year. That happens. So the outlook for the oil companies, maybe you have a different opinion than I do, but I think 5 years from now or 10 years from now, we'll look back at this time and say, we really are at peak oil.
Mike, somebody's asking about cybersecurity stocks. It's an interesting one.
I think a lot of things are changing on cybersecurity. Uh, where will we be 5 years from now? I mean, right now, a lot of my crucial programs are personalized. I have an authenticator. In order to get into interactive brokers where I custody accounts, I have an authenticator, and if I leave my phone at home, I'm almost terrified because I can't get into see the accounts. I did leave my phone at home. I forgot it one day. What did I do? I drove home, got my phone, and came back.
Hmm.
We're seeing the software companies understanding that they need to do something to keep people from accessing and cybersecurity. So what is the potential 5 years from now? Um, I I'm not sure about cybersecurity, to be honest. Asked me 5 years ago, and I did own cybersecurity stocks, not anymore. Because I have the feeling that we're coming to an end. Plus, I have a grandson that works for AWS, and I understand he's a software engineer, not a programmer anymore, because he has AI to do a lot of programming for him. We're going to see more and more of that. We're going to see more problems with cyber hackers, and we're going to see a bigger and bigger response. I think that the software companies are going to build in safeguards, and cybersecurity is only a question mark.
Mike, somebody's asking if, hold on just one second. Let me just grab this and read it again. With solar and EVs using silver and China restricting exports, should we buy physical silver or silver stocks? It's a great question.
I don't know. That's your own decision. If you do the work and you think that the 5 year outlook is excellent, then buy. And if you can't say that the 5-year outlook is excellent, I wouldn't buy.
Mm.
That's not something that I own in my client portfolios. It's not something that I can see owning in client portfolios. But you may be able to do the work and find that you believe that they're superior performance and own it. Or you may find that it's a dud and not own it.
Mhm.
You have to do on that, you should do your own work. I haven't any recommendation for that.
Mike, somebody's asking if you ever feel uncertain or conflicted, and what's your process when you feel that way?
I feel that way once every 3 years, maybe even
Yes.
maybe a few times every year. Um, that's why I turn to my spreadsheet and I look at the stocks. I look at where I expect them to be in 5 years, 10 years, and say, do I still really believe this? I'm a numbers guy. I don't listen to the story. I listen to stories, but I don't believe the stories to be true. You know, the numbers don't lie. People developing stories can lie.
Mike, somebody's asking, what do you do specifically? What do you do differently that leads to better outcomes?
I think I spelled it out. I look at 20 or 30 stocks a month.
Mm-hmm.
Um, from those, I look at 8 or 9, the financials on them. I look at the balance sheet. I look at the income statement. And let me say this. Um, I look at things, I look at stocks. I like stocks that have two types of stocks. The first type of stock is one that has more cash and positive cash flow and more cash than the market cap. That means you can buy the shares and they have more cash on the books than the price you're paying for the stock. And they have positive cash flow. In my entire 40 years, there have been 2 stocks like that. They've been huge winners. Um, the second thing I look at, or the second type of stock I look at, is a stock that has 4 characteristics. Number one, um, it has a franchise on its market. So it has pricing power. It is the dominant stock in its field. It has a squeaky clean balance sheet.
Mm-hmm.
You know, earnings or growth comes from earnings, borrowing, or issuing capital stock. I'm looking for stocks that can grow because of earnings. I'm looking for a squeaky clean balance sheet, not long-term debt. Third thing I'm looking for is for the management or the owners, the founders, to have a significant percentage of the stock so that they have a vested interest in seeing the stock higher. And the fourth thing I'm looking for, a limited number of analysts. In the old days, the first days, I was looking for stocks that had only less than 3 analysts. Today, it's hard to find that. 7, 8, 9 analysts, maybe. So I'm looking for stocks which have fewer number of people following than most.
Mm-hmm.
That's the second type of stock that I really like. That's what I do to get to where I am.
Mike, as we're approaching the top of the hour, I have one more question. There's one more question queued up, and then I have a question, Mike. And the question queued up is: do you buy high tech shares like Nvidia, Apple, Amazon, and Google?
So I do. Uh, I owned a little bit of NVIDIA. I have not owned Apple. I haven't owned. But, if you look at where I am in what I do, I'm looking for the stocks that are fairly new, that are not followed by many, where the insiders own a significant amount of the stock. So a lot of the names or most of the names in our portfolio were not known when I bought the stocks.
Mm-hmm.
Anyway, the big
Okay.
stocks that you read about today, if the price earnings ratios and if the numbers supported, I might be looking at, but most of them are way overpriced they're priced out of my ballpark. Let me put it that way.
Mm. Mike, I have a question for you. I ask the same question every week, and here it is again. What do you have on tap for us next Thursday when we're back?
Next week, the $150 crude reality,
Hmm.
protecting your financial well-being from destruction.
Wow, that's a cliffhanger.
It's reality.
You know, Mike, it was just a couple weeks ago that 100 was the reality. And now here we are.
You know, mm, we're not going to be over with this in a short term. It's not going to end in 2 or 3 weeks. We may surrender and come back and say, no, we're out of it. But what's been launched is a long-term affair.
Mm.
That's my opinion. Maybe in a couple of weeks, Moran will say, gee, thanks for letting us out of this whole thing and we want to cut a deal. My guess is that probability is probably less than 1 or 2%.
Mm. Wow.
My guess is $150 crude reality is going to be the chaos we face. How do you benefit from that?
Oh, wow.
How do you benefit? How do you make money in that case? I think there's a way, and
I'm
I'm going
looking
to
forward to
share
hearing
some
it.
of that next week.
Two quick things, Mike, before I hand it off to you to say goodbye. First, guys, in the ladies and gentlemen, in the chat, I placed two links for you. One is to the YouTube channel, which is where all of the rebroadcasts go. So if you head on over to the YouTube channel, you can watch previous episodes and learn even more from Mike. And I ask if you go over there and you find a little bit of value in what Mike talks about, give us a quick subscribe. That helps our channel surface for more people that we can help. I've also put Mike's email address into the chat. If you'd like to send Mike an email, I have on good authority that he checks, reads, and answers every single email that he gets. And you can send an email over to him if you'd like to have a one-on-one conversation with him about your unique situation. And then finally, Mike, for those of you who don't show up early, Mike actually begins the broadcast 20 minutes before the top of the hour every week. And we sit here and Mike reviews and comments on things that are going on the news, and then also shares some information from things that he's picked up along the way. That all starts 20 minutes before we begin. So if you're available early next week, come on by a little early and hang out with us while we get ready for the episode. Mike, with that, we are at the top of the hour. I hand it over to you for the final word.
Well, thank you for being here. I do have a passion for creating wealth, and I do encourage you, if you miss the programs or if you want to go back and look at them, do look at the podcast About Money Radio on YouTube and do subscribe. On that podcast, you're going to get client stories of what I have done for those clients, things that are beyond this. So go look at the podcast, look at the stories. They're short, they're sweet, and they're very, very interesting. And subscribe. And with that, thanks for being here. And I hope to see you next week as well. With that, take care and goodbye.